exactly happened in the country that was, at the time, the 6th richest country on the planet, and the 3rd richest if you include microstates of Monaco, Liechtenstein, and San Marino? So that suddenly, at the end of 2008, everything was on the verge of collapsing. What happened in Iceland that made it the first developed economy in more than 30 years to ask for help from the International Monetary Fund in October 2008? When we think of the Great Recession of 2008, we automatically think of Wall Street and the real estate bubble. However, the scenario that unfolded on this island, nestled in the icy waters of the North Atlantic, was a totally different experience. Within a few months, Iceland, a country of just over 350,000 inhabitants, faced chaos, a near total collapse. What we're going to tell you in this video that we've made together with Value School is the story of one of the biggest financial bubbles of all times. The story of a country that, in just a few years, went from being a place known for fishing, geysers, and volcanoes to becoming an international financial center. Are you ready to join us on the cold shores of the island known as the Land of Fire and Ice? Well, let's get started. Reykjavik, 2007, the Icelandic capital, traditionally known for being the world's most northernmost capital and having the oldest active parliament, is now also a hotspot in financial circles. That's partly thanks to the fact that the Icelandic economy is experiencing a golden age. Since 2003, economic growth has averaged 6.4% annually. The local stock index, the ICEX, has just touched 7,900 points. Since the lows at the end of 2001, the Icelandic stock market has seen an average annual revaluation of almost 60%. At this time, in 2007, Icelanders have become the real kings of the party. Their wealth is growing steadily, and house prices in the capital have tripled in just over 3 years. More Range Rovers are sold in the country than in Sweden and Denmark combined, despite the fact that these countries have a combined population almost 50 times larger than Iceland's. The country's multinationals, banks, and major investors are buying up companies around the world, real estate assets, and even soccer teams. And that's not all. The average family is now 3 times richer than it was in 2003, just 4 years ago. It is the Icelandic economic miracle. But wait a minute, stop. More than 10 years have passed since these unusually golden years in Iceland. Can we really say that it was a miracle? What caused this economic explosion? What was behind such a frenzy? Listen up.
The Bank Run.
To understand the origins of this whole story, we have to go back to 2003. The country's big banks had just been privatized, and at that time, interest rates in the US and the Eurozone were much lower than in Iceland. This scenario was taken advantage of by the 3 largest Icelandic banks, Landsbanki, Bernardbanki, and Kaupthing, to intensively develop a banking operation known as carry trade, which consists of borrowing at a low interest rate and then investing in assets that generate higher interest rates. In this particular case, Icelandic banks took advantage of the country's high sovereign debt rating, and also of having the community banking passport. Iceland is not a member of the EU, but is a member of the European Economic Area, to borrow in euros short term and to lend long term in Iceland, where rates were already higher. And that's not all. You see, this same process also had another consequence. It meant that the banks had to sell the euros they received to buy krona, thus gradually raising their exchange rates. And so, in order to prevent the krona from appreciating too much, the Central Bank of Iceland constantly increased the money supply to such an extent that it ended up increasing almost 6-fold in just 5 years. This in turn led to rising inflation in the country, which, for example, drove up the value of assets and thus the supposed solvency of banking operations. And so the cycle repeated. It was a seemingly roundabout business that soon attracted many foreign investors as well. And exactly the same thing was also done by Icelandic companies and households. They borrowed abroad to acquire assets at home, houses, stock exchange assets, vehicles, etc., etc. This phenomenon is precisely what explains the huge revaluation in house and stock market prices that we mentioned earlier. Well, the fact is that, in this context, the Icelandic banks exploited the abundant liquidity in the international markets as much as they could to repeat this process again and again and again. Even from 2006 onwards, Icelandic banks working through subsidiaries, branches on the mainland, and also through online media, started to aggressively market to retail customers in EU countries, such as the Netherlands and the UK, the so-called IceSave deposits, with the basic feature being relatively high rates. And when this was not enough either, they began to ask for billions from central banks, including the European Central Bank. All this led to a 12-fold increase in the size of their assets in less than a decade. Thus, as you can see in this graph, the assets of the three main Icelandic banks amounted to an impressive 10 times the national GDP, so that you can get an idea of the huge hole that could be created if things went wrong. Icelandic banks owed huge amounts of money, mostly in foreign currency, and on a short-term basis. In other words, they were forced to constantly refinance this debt. And of course, as international market conditions become more difficult due to the financial crisis and the real estate bubble in countries such as the United States, the situation of Icelandic banks became very sticky very quickly. Customer term deposits began not to be renewed. The wholesale funding market between banks, known as the interbank market, began to close amid a huge wave of growing distrust. The European Central Bank, for its part, stopped lending to Icelandic banks because of their risk. And to top it all off, the rating agencies were slashing their ratings. The situation deteriorated very quickly, and the Central Bank of Iceland reacted by raising interest rates to 15% to prevent capital flight. And it seemed to work at first, but when Lehman Brothers collapsed in September 2008 and panic took hold of the markets, everything came crashing down. It was as if a nuclear bomb had exploded in Iceland's financial system. Remember that these banks, in order to maximize the profitability of carry trade strategies, financed themselves very short term in order to lend long term. The result is that they had to constantly refinance themselves. But of course, when that was no longer possible and they were forced to repay huge amounts of money in foreign currency that they did not have, the banks were suddenly faced with an imminent collapse.
97% of the banking sector collapsed in a matter of 3 days. Gudrun Johnson, member of the commission studying the crisis in Iceland.
Keep in mind also that, unlike other countries, the gigantic amount of debt incurred by the banks made any government bailout totally unthinkable. It was simply not feasible. So at this point, banks had to start liquidating their krona-denominated assets to repay loans in euros and dollars. In other words, they sold huge amounts of krona to buy euros and dollars on the market to pay off their debts. This depressed the price of the krona, something that was aggravated by the massive outflow of capital from international investors that began to take place. It made perfect sense that no one wanted to have their money in bankrupt Icelandic banks. To give you an idea, during 2008, the krona lost almost 85% of its value. Suddenly, banks, companies, and households had assets in krona that were worth less and less, and huge amounts of debt in euros, dollars, pounds, or Swiss francs. They didn't even have the money to import goods. Now, at this point, the question that comes up is, how on earth did Iceland cope with this kind of cataclysm? What kind of measures did they take? What was the cost of this brutal collapse? Well, let's take a look.
A clean slate?
In October 2008, when it all blew up, Iceland's external debt was equivalent to 500% of GDP and 32 times the foreign exchange reserves of the country's central bank. It was practically a perfect storm, and the financial system was truly broken. To deal with this difficult situation, the government passed the so-called Emergency Law No. 15, 2008, which, among other things, empowered it to take control of the banks and make the decisions it deemed appropriate with respect to their management. Well, once control was taken, it was decided to incorporate and capitalize 3 new banks to which the national assets and liabilities, as well as the healthier assets of the 3 large failed banks, could be transferred. The idea was that these banks could operate at the same time as the old ones were liquidated. Of course, at the time, it was a very controversial decision. And the fact is that, in this way, what the government did was basically to bail out the deposits of Icelandic savers, while leaving some 6.7 billion euros of British and Dutch investors' deposits trapped in the old banks. A situation that prompted the United Kingdom to apply anti-terrorism laws to freeze Icelandic assets to secure payments. In the end, an agreement was reached. Foreign depositors were given priority in the liquidation, which allowed them to recover their savings. This was not achieved by the rest of the creditors and bondholders. Then, secondly, the government asked for help from the International Monetary Fund, which dispersed some $2.1 billion to help stabilize the Icelandic economy. This amount was supplemented by bilateral financing lines from other countries. This may not seem like a lot of money, but remember that we are talking about a country of just over 350,000 inhabitants. And finally, the third major measure that was taken with the intention of stabilizing the currency was to establish capital controls. This was done to limit capital outflows, which would prevent the krona from plummeting further. These were the 3 major crisis response measures taken by the Icelandic government. Over the years, initiatives were also taken such as partial write-offs for over-indebted families and companies. For example, mortgage balances exceeding 110% of the value of the home were forgiven. For its part, the government also cut non-financial public spending substantially by 12.7%, which was one of the largest adjustments of all OECD countries. This is how total disaster was avoided, and it was achieved largely thanks to the help of the international community. However, this was a strategy that created many myths, but with the numbers in hand, it had a very significant impact.
A steep bill.
Iceland's exit from the crisis brought with it huge waves of myths. But the truth is that, looking at the data, the public bailout of the financial system was the second largest of all developed countries, only behind Ireland. In total, the government and the central bank had to disperse more than 3.24 billion euros to clean up the financial system. We're talking about 20% of GDP and around $7,370 per head. Almost $23,600 on average for a family of 3 people. Not to mention, of course, the huge capital losses of families, or the really bad years that Icelanders went through until things stabilized. In short, this is a story of the Great Crisis that almost sunk Iceland. The fact that it did not happen was because this country was one of the richest in the world, and also because it had generous international assistance. In any case, what we have seen is the story of one of the greatest financial crises of all time. But now it's your turn. How do you think a country can protect itself from financial crises? Any ideas? Leave us your answer in the comments. And if you found this video interesting, please don't forget to hit the like button. And many thanks once again to our friends at Value School for their help in preparing this video. All the best. See you next time.
And if you want to learn more about politics and hear even more of my lovely voice, you can join us at Reconsider Media. We have a podcast at reconsidermedia.com/podcast. See you there.